For those of you that haven't met me before, I'm Sarah Corley. I am the Community Development Manager for DFI, and it's my job to host these webinars. And I have two expert speakers with me today, Peter and Jeremy, who are going to take over for me just now and give their presentations. For those of you that have not been in a webinar before, please, at the very bottom of the screen, you'll have a little menu that pops up, and there is one called Q&A. And if you could put your questions into the Q&A function, it makes it much easier for us to manage and make sure that we try and get around to answering all of your questions during the webinar today. Awesome. And there's a couple of you that have also joined as an attendee without your names. We've got maybe your device instead of a name. So you can actually right click and or go to the more function by your name and change it so that we know who we're talking to rather than maybe iPhone 4. We'll know actually maybe it's Sam or Bob or whomever is joining us. Great. Well, we're at 2 minutes past 3, and I'm sure maybe a couple of other people might be joining us, but we like to be on time. So it's a good idea we'll start our first webinar. Just a reminder to everybody as well, the webinar is being recorded. So if you do really enjoy today's session, you can share the recording with your colleagues. It will be sent around to you in the next couple of days when we've had a chance to process. So do remember that we're recording today's session, and do remember to pop your questions in the Q&A function that pops up at the very bottom. Thank you very much for joining us. And I also want to say a big thank you to Peter and Jeremy, who've given up their time to join me today. And it's an absolute delight that for once I actually have my webinar presenters with me here in Cape Town, which is lovely, so that you'll see the three of us today while we're giving our webinar. So first off, I'm going to pass over to Peter, who's going to give us a bit of a sort of more of a research and theoretical background into what's happening in the insurance and insurtech. And then I'll be handing over to Jeremy, who will give a more practical, hands-on feel as to what's going on in the world as well. So let's start with Peter. Come and join us. And let's share your presentation. Here we go. Perfect. Just put it into the presentation mode, and then off we go. Wonderful. So I'm going to hand over to Peter.
Hi everyone. As you'll see from my cover slide, I'm from CENFRE, with a Center for Financial Regulation and Inclusion broadly. And today I'm going to talk a bit about Insurtech, and basically our Insurtech tracker, which we've done. But first of all, I mean, Insurtech is one of those made up words that has, I'm going to say, almost different meanings to different people. But just to give you what the terms of how we've defined it in our research, we've looked at it being an insurance company or intermediary or value chain specialist that utilizes technology. So we don't specify what kind of organization, just that there's an innovative technology component to this. And as we can see, that why we care about Insurtech, well, I think firstly we have quite a few people making the time to tie into this, so hopefully we don't have to explain too much. But also we've seen that Insurtech has often been advocated as this disruptor of the insurance market, how it's going to change the insurance market. And there's actually been a lot of investment into this market as well. I mean, we have the Willis Towers Watson, the quarterly reports, and they announced that for 4 consecutive quarters, there's been over $1 billion of investment in this space. So clearly it's something that a lot of people think has a lot of value. So as I mentioned, most of the work that I'm talking about will be our Insurtech tracker, and what the trends we've seen basically from a desktop scan supplemented with some expert interviews, trying to see what are these Insurtechs that we're seeing in the emerging markets. Because a lot of the Insurtech insights are from developed markets, very much America and the UK focus. So we're trying to see what's more the potential for this to have a broader impact, especially in the emerging markets. So we'll see we found 292 of these Insurtechs during the scan, and it's in 85 countries. This is actually an update from our database that we did in 2017, and originally had 157 insurtechs. There's actually quite a lot of growth we've seen in this last 2 years. But also, this is a very high growth and high changing space. So if there are any insurtechs that we've missed, please let me know. And just to make it clear, I mean, there's a link literally to the tracker at the bottom of the slide, which you'll also be shared with afterwards. The database is available for download. So you can have a look, but please help me make it better. Yeah, I think that just as a broad introduction, after looking at all these insurtechs that we found, we started developing this theory of how we see these insurtechs developing. And our rough, I would say, framework we have at this stage is we see these 4 stages. The first stage is just the digitalization, taking these paper-based systems, making them more efficient and more cost-effective, making them digital. Then once we have these digital systems, you can partner with other companies around your data. And once you have a few partners, you can start trying to bring in new data that you previously wouldn't have thought of. Things like trackers on your car or health trackers from your smartwatch, tracking whether your customers are actually walking or active. And then from that, we've also seen a few innovative models looking at actually changing the way insurance is actually done to some extent. So taking that in mind, if we look at what do we see broadly overall in terms of these categories, you see that the digital platforms are clearly dominating from what we found. And it's not just that they're dominating, they're increasingly a share of what we found. I think it's important also to note that we're not expecting an individual company to necessarily track from 1 to all the way to 4. It's more of a, I would say, indication of the insurance and insurtech development in those countries, what kind of insurtechs we find there. The other interesting thing that we see is a less focus on partnerships than we did in the previous database in 2017. And the big thing one of my theories around why we see this big jump in the digital platforms is we increased the number of countries from 45 to 85. So we've got a lot of new countries and as we expect the digital platforms to be the simpler insurtech models, we expect to see more of them as we get more countries coverage. So there's more indication of our expanding our reach rather than, I want to say, going backwards as such, as the absolute numbers have been increasing. And one of the things also with the initial 2017 scan was a very strong focus on the tech partnerships. And with that also there was a strong focus with partnerships with mobile network operators. And this makes a lot of sense. The MNOs have a lot of penetration, they have a lot of scale in these markets that the insurers just don't. As you can see just by the SIM penetration rates and the number of adults with insurance in these markets. But interestingly, while we see, I would say, a focus away from the MNOs to some extent, we also see some focus of new kind of platform or new kind of partnerships that are starting to emerge as well. We've also recently did a scan on Africa's digital platforms in 8 different countries. The database screenshot is being shown here. And from that, we already saw that 9% of those platforms were looking at offering insurance as a product that they're offering as part of their online platform. So these platforms include just your e-commerce platforms, but also your e-hailing platforms. Think of Uber coupling it with insurance as well. So, and then just to unpack what we meant by the data and analytics, it's such a broad topic. We unpack that in this update, look at 4 different subcategories. With the smart contracts that automate the payments, and some of them have some blockchain applications, but that hasn't been that big a focus. To some extent, we've seen quite a few chatbots looking at facilitating low-cost customer interactions, also because chatbots don't sleep. And also, as I already mentioned in the trackers, the Internet of Things and telematics, with the the two main applications being the smartwatches or smart devices, as well as telematic devices monitoring driving in cars. And then actually the largest category is machine learning. And a lot of the other applications actually have a machine learning or AI underlying it, or actually have the potential to have that a machine learning or AI application going into the future. And part of that's just because of all this data that we have that's trying to develop to make sense of so much data. We're increasingly going to see a shift for the requirement to handle that, and machine learning and AI seems to be the solution to that. So as the axiom goes, if data is the new oil, then machine learning and AI may well be the new oil refinery. And then looking at the innovative models that we found. So we found at least 3 insurance models that kind of change how insurance is offered to some extent. One is parametric insurance, very strongly related to the smart contracts and new data and analytics. And a lot of these are based on satellite imagery and automatic loss assessments rather than trying to individually assess each loss. And most of the application we found were agricultural applications, but we did have one disaster risk application looking at using satellite imagery to assess how much of the infrastructure has essentially been destroyed after a major risk event. Other interesting or innovative model we found was demand-based insurance, shifting from annual cover to actual short-term cover when you actually need it. I think one of the examples was also just looking at insuring your car per kilometer that you drive. So if you're not driving, you don't necessarily need risk accident insurance. And then the third one was peer-to-peer, which to some extent is almost going back to a mutual model where the risk is pooled by 2 people that you actually know. Again, there's some blockchain applications with Protectic. But the key thing here is like you have this digital system that gives you enough information that you can actually share directly to people that you know to try and pull that risk. And this, I want to say the marketing spin around it is the risk pool that's unutilized isn't then just kept by an insurer, it's redistributed to the peers contributing to this market. So what do we see? And after looking at all these models that we found, what we actually realize is all of these seem to be pulling together to develop this digital ecosystem. You don't have to have these all separately. They can actually all work together. And just to go through that, so you'll have an insurance and other financial services as well. They're all digitized. Then from that, you can able to partner with different organizations who have also digitized their systems. And from that, then you bring in new data and analytics, trying to unpack customer needs in a new way by utilizing data you traditionally didn't have. And after that, and then it also provides the opportunity, in the scale is the big thing that it could unlock, is especially for products like demand-based insurance, where you have such small products that you need sufficient scale to be able to sell these and make a profit. So I think that broadly overrides what we found in our theory of how we see the insurtech growing and developing into this kind of hopefully customer-centric digital ecosystem. And I think, that I'm going to stop there and let's see what Jeremy has to say and whether this resonates with him.
Peter, we'll move on to Jeremy's presentation. Just 1 minute and we'll share that one with everybody. Here we go. And I'll hand you over to Jeremy.
Hello, it was interesting chatting to Sarah kind of earlier and saying how unused she is to actually having people in the office when we actually do a webinar, because it's so used to being kind of remote. So it's nice that we're actually in person in some ways. Thanks again for the feedback, the overview, Peter, and also for the kind of introductions. So we're basically one of those insurtechs, or inclusive insurtechs, as they call it these days, where we focus on the emerging markets, currently based in Kenya, Rwanda, and Cote d'Ivoire, and going beyond there. We design, build, and operate and innovate inclusive digital insurance solutions. So that basically means with large distribution partners such as Equity Bank, Airtel, or Orange, and with local insurers, we basically provide a kind of end-to-end service from product development, pricing, right through to providing the kind of full platform that allows a full end-to-end solution. About 660,000 kind of policies upwards and growing from there. So just on that kind of basis, we've also gone through the pain that many startups have in terms of startup learning, trying to test kind of customer demand, understand some of the challenges that they're facing. So basically, I thought I'd kind of give some feedback kind of around that. And certainly one thing I would say, reinforce what Peter's saying about the need for customer-centric kind of product, really respond to the needs of those customers. And that's something which we really do try and do. And so while we spend significant amount of money on human-centered design products, where we spend a couple of weeks in country talking to customers, we realize that even with those insights, we still need to do a lot more to be able to understand the needs of kind of customers and respond accordingly. So if you look at the kind of some thinking around lean startup and saying we do need to do a lot more testing and learning around kind of customers' needs in order to address the product needs of customers. And I think we're still a long way in the insurance sector to from developing products that really meet needs, that really address kind of the requirements across those countries. But if I look at some of the other kind of challenges we're seeing in the market, one of the key things I would say is around the payment hygiene factor, which underlies a lot of what can be done in terms of product, in terms of data, kind of AI, etc. And if you look across the certainly the African markets and emerging markets, most of the focus around payments has been addressed around push payments. So where clients are required to initiate payments themselves and authenticate each and every time they make a payment. And there's some good reason for that because of the abuse of customers from whether it's ringtones or other kind of other value-added services. But we're seeing that it's a real inhibitor when we look at kind of high commitment products such as insurance or even pensions or savings products, which really needs to have almost frictionless payment models where you can sign up once and then pay on an ongoing basis. And in the market, we're seeing, let's just talk about a couple of those things. One is recurring payments. So the ability to pay on a recurring basis. Now, if you look at Mojo Loop, which is this very well-funded initiative of the Gates Foundation, that's predicated on push payments, unless I'm out of data around this. And even when they're pushing this across multiple markets, unless they can actually kind of shift to allow frictionless recurring payments, you're actually undermining the insurance model. If you look at behavior economics, we can see that every time you make a payment, it's essentially almost a sale. And that's tough to do on a monthly or weekly basis. So we see some of the recurring payments being critical, looking in terms of how to sell via call centers. So whether you're an e-commerce provider, whether you're a bank, mobile operator or retailer, one of the most successful models in developed countries has been around outbound call centers. But unless you can basically collect the premium over the phone, you have huge what's called not taken up. People promise to pay but don't follow through. And again, collections around even using kind of airtime deduction. So why I highlight the payment hygiene factors as a challenge in this, it means that when you look at data, and I like that point around machine learning and AI being the oil refinery for the new oil. Well, we did an experiment around kind of machine learning where we basically developed a predictive model around about likely take-up, and the confidence level was very high on the model. So we were very excited about that. The challenge is in the country that we were operating in, we weren't able to initiate payment from the call center. So clients had to promise to pay, and you weren't able to do recurring payments. Clients had to do a push payment model. That's based on the partly regulations, but more the way the custom of those businesses. And out of the 200 people we phoned, I think only one person paid. So again, from the oil refinery side, you're producing something which actually has no real value. So we need to understand how we start pulling things together from, from the data, from the oil refinery of data of machine learning and kind of AI, and then from there, understand what are those hygiene factors that need to be in place to be able to make those work effectively. So you can see payment hygiene factors being core to how data is being utilized in the market. Also in terms of making sure that you're meeting products that are meeting the demand of the customers at the time they need it. Because insurance is predicated on the fact that, that insurance is there when you most need it, when you have a risk event. If you don't have a frictionless payment model, then it's very unlikely to be there, whether it's a demand-based kind of insurance or peer-to-peer, or whether it's a just more traditional model. In terms of kind of e-commerce, we're really excited about the e-commerce models kind of going forward, and certainly the platforms and the platformification we're seeing kind of Africa and other markets. I mean, it creates a huge source of kind of data, a huge source of customer engagement, and a huge source of even kind of revenue for those playing in the kind of value chain. I think what we'll need to understand is saying, how can you link insurance into those platforms in a way that helps build the trust in those models? Because if we're seeing some of these platforms around, supporting kind of Uber-style labor models, there's still lack of trust in the quality of those labor models. Insurance can help provide guarantees or such way to build and trust, provide a value add to their customers, and of course kind of drive revenue. But again, if we can't understand how to address the payment hygiene factors around ensuring that you can have regular payment, it's going to undermine the potential for those kind of platforms going forward. So again, just comments. I think there's a lot of excitement around the potential across those different stages. But again, underlying it is saying, let's understand what are those hygiene factors that will enable those models to work effectively. That's my 2 cents for now.
Great. Thank you, Jeremy. So I'm going to ask us all to gather around as a panel so that we can start to answer some of your Q&As. So hopefully most of you can see all of us, or we'll stop the screen share. There we go. So most of us are in. Fantastic. So we've had a couple of questions come in already. If you have more questions for Peter and for Jeremy, please pop them in the Q&A function. Let's start with Miguel's question. Within the insurance value chain, where are you seeing the highest use of technology in emerging markets? He feels that maybe there is little progress from a tech perspective on the customer acquisition side. Jeremy and Peter, what are your thoughts on this?
I have a bonus slide on the back, so I have just to find the right button. But yes, in short, I agree with you completely. This is definitely what we've seen. It's not in the meeting floor. That's not the button we want to press. Yes.
You're in there. I think you are sharing the screen. Is this the slide?
Just the next.
There we go.
So if we look at the, we looked at 5 different strengths that insurtechs could address. So at the top there we have access to customers. A lot of them are looking at the access, but very few of them look at consumers with inexperience with formal financial services. So a lot of them help with access, but it's not so much for your undigitized or non-digital customers. It's a lot of it's online digital platform comparison sites. So you need to be online, you need to be utilizing the internet already to be able to make use of this. There are very few that work on expanding essentially the reach of insurance. A lot of it's more about serving the existing insurance base better rather than expanding the reach, at least at this stage. And I think a lot of it's also, like I said, a lot of it's about the digitalization stage. So you kind of need that, I must say, first to expand the reach. You want to get your easy to reach customers first before, with 2%, that you can still very much, that's still probably going to be your urban salaried mobile customers. rather than you're difficult to reach the customers.
So just on the acquisition kind of side that you're kind of looking at, again, it links down to the customer engagement. We're still seeing, the dominant model on the tech side is still USSD, which is very simple. But there's a good reason for that. It's available on all phones and it's accessible. And personally, I'm so under excited about an app for insurance, unless it provides additional services. I think a lot of the insurers have now launched apps, which basically now you may download for interest and then you forget about it or you delete it later. And particularly if you look at these kind of emerging markets where smartphones are increasingly being deployed out, if you look at them, they're pretty cheap smartphones. They have limited capacity and data is a cost as well. It is a high cost relatively. So again, what is the use case of having an insurance app which you use on an infrequent basis? So from the acquisition side, I would say, one, you need to have it widely available. So whether it's USSD, kind of Mobi side, if it's going to be a smartphone, then link into other apps which are used on a regular basis. Equity Bank in Kenya, even them with their kind of focus around digitalization and smartphones and the mobile banking, I think the penetration of that app is still pretty small compared to their overall base. And that's a banking app which you can use on a regular kind of basis. So again, if you're going to think around digital acquisition models and looking at apps, link into something that someone does on a regular, frequent basis so it's useful and adds value to you. So whether that's a banking app, whether it's a Jumia, kind of e-commerce kind of app, or an Uber, whatever that would be. That's where I think the interest is around that digital side kind of coming in. These are some which engage on a frequent basis.
Great, thank you very much. I hope that answers your question, Miguel.
And so the second question as well.
Yeah, no, obviously very curious, Miguel. Have you been able to categorize the Insurtechs by business models? If so, out of the 292 Insurtechs, how many are peer-to-peer, parametric, etc.? So this is for you, Peter.
Something I prepared previously.
Do you have this one prepared as well?
It was actually in my presentation at the start. So you might have joined a bit late, but at the beginning we did actually show the overview of the different kind of categories. So cycle all the way back. So here we see, so of the 292, 57% are digital platforms. I can't quite do the maths in my head, but you asked about the peer-to-peer and the parametric. The peer-to-peer, if I remember correctly, were 8 or 9, and the parametric were about 13. So yes, we have that data. And as I said, also at the right at the beginning, you can also look at this data. You can go, it's on the website, on Cindy's website. You're happy to go download it and play with it, and also tell me if I'm missing any.
And we'll send that link around to everybody that's joined the webinar today, and we'll also put it with the recording as well. So you'll be able to find that link very easily if you can't find it straight away. Great, so then let's move on to another question. I think I quite like this one that's come in from Halima. Let's ask, why does South Africa have more insurance across Africa compared with other countries? Jeremy, maybe this is a good one for you to start, although that's not your focus area in terms of countries.
Well, I mean, that's interesting. It's one of the reasons we are based out of Cape Town, mainly because wife's orders in my case. But South Africa's penetration is far higher than many other markets, and I think it's come for a number of reasons. But the penetration is patchy. So it's highly penetrated on the funeral insurance market because that's a culture-driven product. But if you look at the short-term insurance products, then it's actually penetration is pretty small, particularly in the low mass market. Penetration is actually very low if you look in, say, affordable housing insurance kind of space. So you really need to understand what product segment are we talking about in South Africa compared with other countries. But it's also a factor of established institutions and strong brands in this market. So if you look at kind of Edgar's and Jet, which is a large retailer, which I maybe said it, but I know a few years ago they were generating 100 million rand a month in premium. That's a significant amount of premium because they've got strong brand, well trusted, and they address the payment hygiene factors. Because basically when you sell the policy, you collect it with your store card. So when you're paying at the end of the month for your clothing, you're actually paying your premium at the same time. So again, it addresses one of the key issues that I was mentioning earlier about payment hygiene factors, a frictionless way to collect your premium in case of along with other kind of services. And same with the banks, they've also heavily focused on insurance, either embedded loyalty, so ABSA has free funeral insurance if you have a bank account. Clicks as a retailer has free funeral insurance if you are an active customer of theirs. You've seen a combination of culturally driven initiatives plus sophisticated organizations that have strong touch points with the customer base and ability to collect at the same time. But yeah, it's a real kind of story, and we're really looking forward to seeing how we can change that dynamic in other countries going forward. And yes, Nigeria, on the question above, is an incredibly difficult market from a regulatory kind of side, statewide kind of insurance for the micro insurance side, I understand, challenges on regulations in terms of payment hygiene factors. We haven't looked at Nigeria recently, but doesn't support airtime deduction models, which is one of the models that allows a frictionless way to collect kind of premiums. So again, real challenges to address that.
Yeah, I think just touching what you mentioned with the South African penetration, I think that the key there is the comparison with other African countries. The insurance penetration is really, really low. And at the moment, most of the insurtechs we're seeing are supporting existing insurers. So if there isn't much happening in that market, there isn't much space for insurtechs to take off, at least not yet. Though you could argue, the counter argument, of course, is they're less legacy systems. So it's easier for them to disrupt this market. But at this stage, I think until we see more disruptive insurtechs take off more, the focus seems to be more on supporting the existing market.
Anything to add, particularly about Nigeria?
In the sandbox discussion?
Yes, so the Nigerian market is difficult to work with, and how do you engage with the regulator? I think at the moment there's been a lot of hype, I'm going to say almost, about sandboxes, tests, but often these almost over-engineer what you require from the regulatory side. But we're actually working as Senfree with a couple of regulators to provide them with some support. Primarily around, increasingly, regulators have, or traditionally regulators were, they had a consumer protection mandate. More recently, we have consumer protection mandates almost with, while they also have a market development mandate. And have to kind of balance off these two. And when the market development mandate is the key, where we see more the need for better engagement. And it doesn't always have to be like a full sandbox solution. Often it actually comes down to simple solutions, such as being more open with their communications with the market. And it's as simple as just making sure that when you make decisions that it's clear to the market that that's the decision that's been made, and that the market also, if you're entering into the market, that's clear, say on the regulator's website, who they have to email, who they have to contact for which queries.
Yeah, I mean, just one thing, I mean, I was involved somewhat in the past, but I mean, in terms of case studies, have a look at the Access to Insurance website, A2II website. And that's one thing I would say around the insurance sector. The insurance regulators are far more proactive around insurance market development than any of the other standard setting bodies or regulators. So I think there is a very much open door from regulators to listen. I understand Nigeria is particularly challenging. So in theory, they're open, but obviously there are challenges in particular markets. But in terms of Ishmael's question, have a look at the A2II website.
And good luck with your product in Nigeria, Ismail, as well. Awesome. So let's move on to another question here that we've got. Looking at the framework of insurtechs from a horizontal perspective, looking at data analytics, P2P, digital is helpful. What kind of, do these perspectives apply equally to the vertical insurance segments as health, agriculture, and other insurance verticals?
Again, I have another bonus slide.
You need to come very prepared today. Well done.
This is why I kept my slides short. You will have everything.
So right, let me see. So looking at it from a product lifecycle perspective, first thing that's actually quite interesting is most of these insurtechs that we found, at least, are agnostic. They're not particular to vehicle or health insurance. But further than that, we do see some focusing more on vehicle insurance and life and disability. But I would say almost those easier, almost commodifiable insurance products seem to be the focus, at least at this stage, which, I mean, with the lower penetration and the initial digitization focus, seems to make sense. There's also, there are, like, the one thing that does also stand out is the agriculture. There's a clear parametric focus there. I mean, but the digital platforms are just so dominant that they kind of do dominate most of the landscape. Otherwise, but yeah, at least, and then yeah, but then the tech partnerships also playing significant roles in some of those markets as well.
Do you think we'll see a significant shift as time goes on in how what this graph would look like?
I'll be interested to hear Jeremy's thoughts, but I think yes. I think to start with, what you almost need to get that scale. If we do see what these digital ecosystems being realized, you won't have to offer a standard product. You'll be able to offer kind of niche products because the ecosystem will be able to give you the scale that you need to do that. You won't have to offer traditional health. You can offer specified cancer care or very specialist products that otherwise wouldn't be possible because you wouldn't be able to get the scale.
I would fully support that. I mean, it's one of the things we're doing quite a fair bit of work around is basically almost predictive underwriting models, or at customizing products to individuals. So, for example, we work in one mobile operator where we can basically, based on the data of the customer, can then say, we know the kind of cover you typically need, and this is what is the typical level of affordability as well. So you customize the cover and the premium to that kind of, and because of the data, you're actually more likely to be able to offer far higher level of cover and lower premium than you would be if you have a standardized kind of product that everybody buys a certain product which has a certain cover, which is the norm in the microinsurance space. Mm-hmm. So I think that's exciting. So being able to use data from that perspective to customize products, both in terms of the cover, the nature of the cover, and the kind of the premium, I think is playing going to be a big role. We're going to see data being significant in terms of understanding how to manage retention, managing kind of churn. So I think there's going to be significant more deployment of similar number of use cases as the market kind of develops. As I said, there's still some significant payment hygiene factors that need to be in place, because you can have the most wonderful model, but you can't collect a premium, and it's really going to basically undermine the value of that kind of expensive modeling.
I mean, you've mentioned that several times, so I can only assume that is a very big big problem, big pain point for insurance, and different from the other adjacencies might have, and that kind of push-pull payment challenge that exists.
Well, I mean, put it this way, again, depending on the products in the market. I mean, your pay-go solar gets a lot of airtime around that, but again, the penalty for not paying is your electricity, your lighting is cut off, or your TV is cut off, or whatever it is you're using that pay-go solar model. For digital credit, if you don't repay, you get blacklisted, and we've seen all this in Kenya kind of going off, and a huge amount of negative impact of these kind of the blacklisting from digital kind of credit models. So there's real penalty for that. The penalty for insurance is obviously far more personal because the cover is not there when you most need it. Mm-hmm. But again, it has a devastating impact on an individual family if it's not there. But the actual immediate penalty is obviously not limited because there's no, you don't have that implication of no electricity, no water. So that is a kind of a big issue. And that's where, again, we need to see innovation around payment models, from whether it's, bedding it into other services or bundling it along with other kind of services as well. So again, I think that is going to be a big issue going forward. But I'm looking forward to seeing how we will continue to unlock opportunities, particularly as data is going to use more on a more sophisticated basis.
So data really is the new oil.
And even models, I mean, on parametric stuff, there's a paper actually, it wasn't on a website until our site crashed a bit, but we did a study as a BFA with Century actually, back in the day around index insurance a few years ago. And the challenge around index insurance was the technology at the time wasn't sophisticated enough to be able to tell what was happening on one side of a hill compared to another. because it wasn't granular. I'm being simplifying things. But we're now seeing, drones kind of coming in and starting to improve. So you're actually being more accurate around how the actual impact on the ground is of a smallholder farmer than you were previously. Because essentially, it was one example from Oxford Economist. He said that index insurance could be the next mis-selling scandal if developing country regulators were sophisticated developed country regulators. So there was a lot of pilotitis in this area, but also potential for significant abuse. But I think as technology moves on, as we become more sophisticated and really can get granular data, we can start kind of overcoming some of those kind of barriers and starting adding real value.
That sounds fantastic. And a couple of questions of a similar sort of theme. Who are the, other than inclusivity, obviously, which is one of the questions, who are the disruptive insurtechs that are bringing new developments to the market in any of the sectors? So health, financial, kind of who are the key players?
Well, I mean,
or how do we find them?
Well, we can see who we found on the database, but what we don't see at this stage is the scale of the people. So that's not a simple thing to capture. So I don't have a direct line of sight on like which are honestly taking over the markets at this stage. But I mean, in South Africa, the health sector has been dominated by Discovery, and I think what they've done really well is almost develop that kind of ecosystem, because they have their Discovery Health, they have Discovery Life, Discovery Non-Life, and if you open your Vitality app, you kind of forget that these are three different entities. And then you also have partnerships with retailers, with partnerships with petrol stations. They're actually getting a lot of data around their customers. And at least in the South African context, they seem to be the one that seems to be the leader, at least here, to my knowledge. But that's completely a personal opinion. I think you've maybe had a bit more experience broader than South Africa. Any other exciting models or competitors that you've seen there?
Yeah, I'm rather really careful around it. So I want to send you to other players. I think there are obviously players. I mean, Mike and Shaw was on the board of some time ago, and I mean they've certainly been around for quite a while and learning in that kind of area. And there are interesting new players are kind of popping up. But again, have a look at that Insurtech database. It's probably the most comprehensive one I'm aware of, and certainly I think it is the most comprehensive Insurtech database there is around. So have a look on there and see who's missing or not. And I think the issue is now trying to say what are the right use cases where you're really going to be able to have the right form of distribution and go to market. And so from our side, we would absolutely have loved to be able to go direct to market, but the barrier to that is huge. One, insurance is extremely is not trusted in this market at all, generally. And that's often by the abuse of insurers who've delivered compulsory products which have poor value for customers and not paying their claims, which is one big issue. So there's a big issue about overcoming trust and creating brand in the market. But for us, it'd be so quick and easy to be able to test in the market. But we are still to believe at this stage that you need to have trusted brands which engage with the customer to aggregate them and offer those services. And the question is, which are those brands that have the scale and have the trust in the market? And a lot of them are established. Obviously mobile operators are the biggest, but they're renowned for being very challenging to work with. I think that came up in the report as well, and I can attest to some of my grey hairs because of that. The banks, great, but again, only in certain markets do they have real scale in this space. These platforms, again, look like they have a lot of potential in that area, but again, what potential do they have? What relationship do they have with those kind of customers? Because insurance needs to be used for different purposes. One, it can be used to help address kind of trust or loyalty. It can be addressed to mitigate your risk. But again, we need to understand what is the value add for the platforms and the platforms consumers of insurance, and what is the use case around that. And that's, I guess, something which we're going to explore going forward. Just picking up on Miguel's query around serving customers, it's actually relatively difficult to work out who has or who hasn't. So some of this is via analogy. So, a market like Rwanda, where we see less than 1% of the population or 2% having insurance, if suddenly we're adding 250,000 to that base, we actually can assume that a significant proportion of those have never had insurance, particularly when you look at their behavior in terms of kind of income or their transactions. But without doing dedicated surveys of those customers, you don't have a database of people generally in these markets that say, yes, I have insurance. No, I don't. There's not something that is generally available. So you have to address this either by assumption in terms of where they are in a segment in the market compared to where the current penetration is, or via dedicated surveys.
I mean, the one Insurtech that does report at least on the number of customers that are actually accessing insurance for the first time is Bima.
That's through surveys, though, isn't it?
It's
with Leapfrog in the past was helping them do surveys of their base.
Yeah. So, I mean, I guess that gives you at least some indicative numbers, but you're not going to get direct numbers for all the markets. And I think just reflecting on what you're saying about, you have to look at who the different players are and who has the brand or the market power in the different markets. We're talking about emerging markets. I mean, there's 85 countries in the Insurtech tracker. I mean, Africa is not a country. Never mind emerging markets is not a country. It's definitely going to be tailored to whichever market you're actually looking at.
Thanks, and we've got Sarah that's come up with a nice question here, particularly sort of when it comes to the trend of paying claims. So how are claims paid out? Any idea? Can you sort of explain how that might work?
I can talk about our model and then maybe talk about general. So in our case, in terms of claims, we try to make it as simple as possible. So you can initiate a claim via USSD or phoning a call center or going to a service center or one of the banks and mobile operators that we work with. So the initiative is simple. We also don't require you to fill in a claim form. You then basically need to either WhatsApp or email your documentation through. Generally, we found that if you don't have a smartphone yourself, somebody you know will have it. Or you can go to a branch or a service center and then email the documentation through. It's then basically uploaded and validated on our platform. And typically that is then paid directly into the mobile wallet or bank account of the customer. Because in our case, we're partnering with mobile operators or banks, we actually have a mobile money or details or the bank account kind of details. So it's paid directly. The nice thing from our platform is we can see when the client initiates a claim and when it's paid out directly. So we don't have the concern of following up on insurance, say, have you really paid it? So we can actually see how long things kind of take and that performance. So on the paid side, I think it's available. And so even if you don't necessarily have the mobile money account, generally you can, outside of South Africa, create a mobile money account and send the link. So you just need to go and validate who you are and then withdraw your money from kind of mobile money. And that seems to work pretty well across all our markets. Paid over 1,000 plus kind of claims without any particular issue on that side. On the frictionless payment models, we're seeing a few things in the market. I mean, airtime deduction is kind of one of the popularized ones, but it's being closed down in a couple of markets and illegal in others by regulators either pushing against it or mobile operators pushing against it because of value-added services abuse. So in some cases, I better not mention name, but one mobile operator has made a decision to stop airtime deduction models on a recurring basis because of companies doing ringtones and others making deductions without permission, or when they've been contacted by the client refusing to stop the payments. So they've actually had a whiplash against that. But if you look at A2II, they're actually saying it's one of the effective means to address kind of payments. So that is one way, which is relatively frictionless when you say it kind of once. The second way is around bundling it or editing of existing services. So if you have an account, you can then basically say either paid for by the provider, that's the embedded model, or bundling it where you collect it along with other services like Edgar's and Jet in South Africa. You sell the product to an individual, they say yes, then you collect it regularly on an ongoing basis. So you're seeing quite a bit of innovation in that area, but it's patchy and very much dependent on the distribution partner you're engaging with and the type of payment mechanism. It's very tough if you're basically on a kind of airtime loan type company or a company where you're only making one payment, or you're making, even kind of some loan companies where you have short-term loans. Again, you may have cover during that period, but what happens when that loan cycle is over? So again, we're going to have to think around innovations around ensuring that there's cover during those kind of gaps in payments. So still a lot of work to be done there.
Yeah, I think that was a very comprehensive answer. I'm not going to try to add anything more to that.
We hope that answers your question, Sarah. Let's see what else is coming in. So Ismail is asking about funding research and into Insurtech in Africa. Are there any organizations out there? Obviously, Senfri have been doing some work and a lot of work on that particular. Is there anyone else doing sort of similar research, or not the same, but that would be useful, for example?
I'm trying to think. I mean, BFA have been doing a lot of work around customer outcomes to some extent, CGAP as well. Not sure of any, say, specific applications.
The FSD Africa, obviously, who's actually the client of Senfri and implementing a lot of this work, I think, has obviously been part of that.
Yes. I mean, the Insurtech tracker was funded by FSDA, essentially. So that's broadly, they do have a big interest in this, and there's also a lot of interest in the same as from the UK development aid kind of focus as well. I'm not sure whether that have any specific focus in Africa.
And individual FSDs, like in Nigeria, EFINA, is a good person to, a good organization to touch base with.
Okay, we've got another question that's come in from Guy. If you had $1 billion, so this is a definite dream, so we suddenly become rich, guys, and it's been allocated to be used for micro insurance, how would you split the allocations of funds between building tech, distribution and admin capacities, and customer education and awareness in order for having the largest long-term impact on underserved communities? Good question, Guy.
Very good question. You have an answer for it, or you also still thinking?
Well, $1 billion is a lot of money, and funny enough, we had a discussion with a certain investor, which is their minimum investment is $100 million. Absorbing $100 million in Africa is relatively tough when you look at the number of players, even outside the insurance sectors, when you're talking about $1 billion. But I mean, these days, tech can be done relatively inexpensively. They look at the open source kind of technology and such like, and they're saying that in some ways it's better for security. You can do tech relatively kind of inexpensively if you have the right team and the right understanding. It's not just about the tech. Tech is obviously only kind of part of that. So I'd probably say, yeah, tech is obviously going to be a chunk of that because you want to start bringing in kind of AI and such like in that. But again, unless you have distribution and the way to access the market, then you're impeded. So if you had $1 billion, I would love for us, actually, we would love to go direct. I mean, that would be wonderful. But again, you obviously need to think around the economics around that and how you engage, get into market. For example, BIMA's used on many occasions. I would love to understand how BIMA make that agent model work effectively, actually, because it's a high cost model, having individual agents managing a sale on very kind of small premiums. So unless you're basically moving upstream, or again having multiple kind of products, then it's hard to make those economics work. But if you wanted to have a play, I would probably have the right tech, the right kind of platform, but again, a lot of it I think would be around saying what is the best way to get the distribution at scale supported by kind of the right kind of payment capabilities. So probably have quite a play on customer education, Guy's ex-Hollard as well as I am, and then you actually saw that Hollard found there was a real business case for financial education. They're actually saying they actually had a regulatory requirement in South Africa around the financial sector charter. I think it was 0.1% of post-tax profits. I think they increased it to 8 times that because they actually saw that there was a payback for focusing on financial education, and that clients are better clients because of that. So again, if we can get those mechanics right in terms of getting the distribution supported by kind of the financial education, consumer education to get uptake, as long as you've got the payment capabilities in the background, then I think it would be a pretty good play. But it's an excellent question. I'd have to think about it a little bit more too.
And only your or asterisk I put onto that answer is it'll of course differ from country to country. So
completely.
Like especially your distribution. You with some countries you might have to almost build an entire distribution system. Others you could basically work with the right partner and utilize that.
100% agree around that.
Great. Thanks for a great question there, Guy. Got a couple of questions about how insurtechs are disrupting the agriculture value chain, similar to how fintech is just disrupted banking. How will this impact? What is the reaction going to be from maybe the big insurance companies? Will they partner? Is it going to be like a similar sort of, do you partner, do you collaborate, or are you disruptors? What are the thoughts on that sort of space?
Well, I think there's a lot of regulation around insurance, and I think my feeling, speaking to the people in the field like Jeremy, have been that's actually been often a very difficult thing. And to come in as a new insurtech, it's often very difficult to come in as an insurer. There's often high costs for an insurance license in a lot of the emerging markets. So I think that what's probably, I would say, almost more interesting would be for me is like those avenues that allow easier, lower cost entry into the market. Things like your self-captive arrangements in South Africa, where you're able to almost subcontract the insurance license and purchase almost a part of a license rather than a full license. It basically gets your foot into the door. And interestingly, of the South African insurtechs, there are quite a few that are actually self-captives. So I think it's, in terms of disruption, I think the other interesting thing is, we're talking about a lot of different countries. Some of these countries, the insurance market is so quite underdeveloped. So if you're able to come in with a strong play, you could be a lot of people's first experience with an insurer, and you could theoretically, and without having to deal with legacy system, there is a potential there. But those are probably also the markets. There's also a reason the insurance penetration is so low. There are still restrictions. I mean, not everyone has internet connection yet. And for a lot of the technology applications, internet connectivity is a key requirement. So, yeah.
That's interesting. Obviously in the banking time, you talk about open banking. And initially it was like, hey, we've got to close down these kind of fintechs because they're basically taking our lunch, to saying, actually, we'll provide that open banking where we'll allow kind of fintech to plug in and provide that kind of value add. I think you're seeing something on the insurance side as well, where you're seeing initially protective, but then saying, actually, maybe we need to think around the open insurance space where we actually do need to allow companies to kind of come in. I know just one example in one country, we did the business case to launch with a distribution kind of partner. The insurer did their business case, they plug in their typical cost to do technical integration. In the end, they used our platform fully, so they didn't need to do that. But the cost they allocated was pretty much the cost we spent on building our platform in the first place. So, and it basically killed the entire business model.
Yeah.
And because they basically have this kind of legacy platform that even minor tweaks are extremely expensive and challenging, they've also actually turned around to us and saying, actually, you've got two things. One, obviously the cost of making tweaks to the system is going to make it hugely challenging. Two, their own claims team is saying, we prefer to use your platform than ours because it more than reduces the time to process claims by more than half. So it's a significant improvement in terms of the quality for their own claims team. So they now said, okay, well, we want to just use you because you brought the partner. Now can we use you with our other kind of new partnerships kind of going forward, because you bring IP, but you also bring a platform which is flexible and more suitable for these kind of digital kind of initiatives. So I think there is going to be a continuing tension between this focus of we need to cover our investment in these $1 million kind of old legacy platforms, or even new legacy platforms, which are already legacy as soon as you've opened it up. And this kind of open insurance where insurers are saying we do need to leverage off these fintechs because they are, or insurtechs, because they're often closer to market and a bit more agile and can test and learn in the market. Because again, we don't have the ideal product and the ideal model in all these markets. Otherwise, insurance penetration would clearly be far higher than it is at the moment. And one thing that's clear is, these big insurers, they are relatively comfortable in these upper end markets. And so when I was BFA Century, study we did in Kenya, you're saying the market is kind of cannibalistic. They're all basically eating each other's lunch in that 5% of the population. And very few had the incentive to actually move down. But the whole setup from system, from products to administration was around serving that upper end market. And again, suddenly jumping down to mass market model is quite a leap. And that's where insurtechs can play a big role.
So like the cost effectiveness and the speed of which you can process, transact, all of those things make insurance more affordable, and therefore you can reach more people with a more affordable product, right?
Yeah.
Cool. And so I'm going to finish because we're at 4 o'clock and we're almost done. But it's that kind of question I want to come to just to finish, to remind us why we're doing this in the first place. So what is the link between insurance and financial inclusion? How is insurance and insurtechs making an impact on financial inclusion?
Well, I mean, Insurtech is basically, like, as you just mentioned, it's that making it cost effective, helping insurance penetration expand. At the moment, the insurance penetration in most of these emerging markets is 2% of GDP on average in all the countries in the Insurtech tracker. Whereas, so clearly if they are, and people are facing risks, the question is that they don't have products like insurance to help them overcome or facilitate the resilience in that. So Insurtech is definitely, I think the key thing for the Insurtech, I think, is about cost reduction, at least at this stage. With the digitization, we'll see more niche and more innovative products going further, but I think given the low penetration, it's correct that the focus now should just be on getting things more cost effective.
Yeah, from my side, there's actually a blog I wrote some years ago called, I think, Microinsurance is Cinderella of Financial Inclusion. And it's basically part of the argument that insurance was always seen as this last order financial payment. Like, you build everything else first, and insurance comes in at the last. You know, almost say, what do they call that kind of pyramid, Maslow kind of hierarchy of needs. But actually, if you look at some of the stuff on the blog and what we've also seen private, insurance is often an enabler for other services. When we launched MTN at Hollard, we saw that 40% of clients were new to who took up insurance were new to mobile money. So they were signing on to mobile money in order to get the insurance. So you're seeing insurance as an enabler. With equity in Kenya, we've got quite a lot of data which shows that insurance is actually driving digital payments more so than those who don't have insurance, or actually supporting them to, I guess, the broader digitization kind of strategy more broadly. So insurance is not only something that addresses your Maslow's hierarchy of needs at the end, it's around saying how to enable financial inclusion, how to address that, how to provide access to other services. If you look at access to credit, access to healthcare, access to education, insurance is often an enabler to be able to address that, and address real needs in the market, and obviously to address the risks that really matter, whether it's, you know, housing. If you look at housing, the penetration is so small, but in this market, if you lose your house, you typically not only lose your shelter, you lose your contents, but you actually also typically lose your inventory and your equipment and your inventory as well, because so many homes in the low-end market store their equipment and inventory at home as well, or even run a spaza shop or a small informal shop from the house as well. So again, unless you have insurance, you're actually going to impede the dream of trying to get kind of an inclusive financial market.
Thank you very much, Jeremy. And I think that's a really lovely point to end the webinar on today. Thank you to all of those that joined us. I hope you've had a good session with us today. I've really enjoyed it and feel like I learned a lot more about insurance today. Thank you very much. Oh, sorry for the blurry camera. Thank you very much to Peter for sharing the research from Senfree. And I'm really looking forward to going and looking in more details about the tracker. And thank you very much, Jeremy, for sharing your kind of hands-on opinion and views about what's been happening since you launched your products and platform. And also just to congratulate you again for your winning of the FinTech 50. So for those of you that missed or saw our webinar last week or have heard, Jeremy's company, Inclusivity Solutions, was one of the top 50 FinTechs as voted by the competition that was run by Mix. So we're really pleased that we had two fantastic expert speakers with us today. So thank you for sharing your time with us. And thank you also to our attendees for joining us and sharing great questions with us. And we hope to see you at our next webinar. Thank you very much.
Thank you very much indeed.
Thanks.
Bye-bye.